After a company finishes recording their adjusting entries and posting those entries to T accounts, they need to prepare an adjusted trial balance. My method for preparing an adjusted trial balance is to prepare a worksheet. The reason that I prepare this worksheet is because it's going to list the amounts we had before we made adjustments, the actual amount of adjustments that we had, and what our trial balances are after our adjustments have been made. And the reason that we need them after adjustments is because that is going to be the set of numbers that we use to prepare our financial statements. So this worksheet contains both the unadjusted trial balance, the account balances you had copied from your T accounts before adjustments were made, and your adjusted balances, the amounts that you have after your adjustments. You don't need to disclose your unadjusted trial balance to anybody, but in case an error happens, I feel like this format makes it easier to go back and find out where your mistakes are instead of having just one adjusted trial balance. Let's go first and record the adjustments for Luscious Landscaping in this example. On January 31st, they need to adjust their books for depreciation incurred on their long-term assets, and they're going to use the straight line method, taking an equal portion of the value away each period over the life of the asset. They have two different types of assets they are depreciating. They have their equipment, which had a historical cost of $3,600. They estimate that it's going to be useful for 3 years, and it's going to be completely worthless when those 3 years end. They also have a truck, and the truck costs $26,000. They estimate they're going to use that for 8 years, and they think at the end of those 8 years, when they're done using the truck, they can sell it, probably to scrap, for $2,000. Well, we can use our straight line formula to figure out the value of both. For the equipment, we take the historical cost minus residual to figure out how much we're going to depreciate. We're depreciating the full $3,600 in this example. We multiply it by 1 over useful life, and then we multiply it by 1 over the number of months out of 12 to figure out this month's particular amount of expense we're going to recognize, and the depreciation expense on the equipment is going to be 100. We're going to use the same formula for the truck. $26,000 historical cost, but it's going to be worth $2,000 at the end of its life, which means we need to remove $24,000 worth of value over the life of this truck. We multiply that by 1 over useful life and 1 over 12, and we come up with an expense to be recognized on this truck for depreciation of $250. Well, with that, we can record the adjusting entry on January 31st. The January 31st adjustment, like the depreciation expense adjustment is always going to be, is a debit to depreciation expense for the total amount of expense that we're going to recognize. Equipment was $100, truck was $250, which means we are recognizing $350 worth of depreciation expense. We're going to have not one, but 2 accumulated depreciation accounts separated by the type of asset. So we have accumulated depreciation on our equipment, which was $100, and accumulated depreciation on truck, which was $250. But our debits still equal our credits. We got $350 on each side, so our adjustment is good when we adjusted for the depreciation on these long-term assets. Next, we're going to have to figure out what our adjustment is going to be for a physical count of supplies at the end of the period. Luscious Landscaping has $800 worth of supplies left at period's end. But what did they have before? We can find that on our unadjusted trial balance. They had $1,000 worth of supplies before we did this physical count. Well, if there was $1,000 worth of supplies on our books and we only have $800 left, then we must have used $200 worth of supplies, which means we get to recognize an expense of $200. And in that adjusting entry, you debit supplies expense for $200 and you credit supplies for that same $200. In our next adjustment here, we have that on January 31st, Luscious Landscaping performed its monthly service obligation to Paradise Square Park for a previously signed contract. Under the terms of this contract, Luscious is going to provide monthly service to Paradise Square for 6 months, the period from January to June, and Paradise Square is going to make payment in full at the end of the contract's life. Well, what's the entry for this? Well, first let's figure out how much we get to recognize. Again, assuming that our obligations are spread out evenly over the entire life of this. If it was $6,000 for a 6-month contract, we're going to recognize $1,000 worth of revenues each month. And in the entry to do so, we're going to debit accounts receivable. Why? Because they're not paying till the end of the contract's life. They still owe it to us. So we debit accounts receivable for $1,000. We can recognize $1,000 worth of revenue because we met those performance obligations during the period. So we credit service revenue for $1,000 when we adjust for revenues accrued on this contract with Paradise Square Park. On January 31st, Luscious Landscaping is going to make an adjustment to recognize a portion of another contract. This one is with Green Hills Apartment. Under the terms of this contract, Luscious Landscaping got paid in advance, so the money came up front, and it was $4,500 for services to be provided evenly over the next 3 months, January through March. So the entry for that would be a debit to unearned revenue. Why is it unearned revenue and not accounts receivable? Because we got paid ahead of time, which means we owed something at the time that we got paid. We owed those services. Well, we don't owe that portion of those services anymore. So we're going to debit unearned revenue for $1,500, and we are going to credit service revenue for $1,500 when we adjust for revenues earned on a Green Hills contract. Next up, on January 31st, Luscious Landscaping is going to adjust its books to account for the expiration of January's portion of prepaid rent. The rent prepayment was made on January 1st, and Luscious Landscaping prepaid $1,800 for 3 months' rent. Well, how much is that per month? $1,800 for 3 months means we're going to recognize $600 worth of rent expense when we make this adjustment, or 1/3 of that $1,800 that we prepaid. And the journal entry to adjust for the expiration of prepaid rent puts the actual expense on the books by debiting rent expense for $600, and it removes part of your asset, the portion of prepaid rent which is expired, by crediting that account for $600. On January 31st, Luscious Landscaping is going to adjust its books to account for interest accrued on the company's notes payable to Adirondack Bank. This is a $12,000 note. It is for 1 year, and Adirondack is charging Luscious Landscaping 4% interest for the privilege of letting them borrow money. They are going to make quarterly payments on this note, which means that on the end of January, we're going to assume that they're not actually paying at the time. They're going to pay at some date in the future, but we know we owe the interest on that date. How much interest? Well, you take your principal balance, assume it's the whole $12,000, multiply it by the interest rate, and multiply it by time. So it's $12,000 principal times our 4% interest rate, which is for the year. So we once again multiply it by 1/12 to convert it to monthly, and we come up with $40. That's how much interest is getting tacked on our loan. So we go through and we make the adjustment by debiting interest expense and crediting interest payable for that $40. On the 31st, Luscious Landscaping also has to adjust for salaries owed to employees at month's end. The company typically pays its only employee $1,200 each bi-weekly period. This employee has worked 3 days since he was last paid. Fair enough. How are we going to figure out how much we owe? Well, we're going to take the normal amount of salary that comes in a pay period, which for this employee is $1,200, and we multiply it by the portion of the normal period this employee worked that we have to adjust for. It's been 3 days since he was paid. His typical week is 10 days, or his typical pay period is 10 days, bi-weekly period. So if we take 1,200 and multiply it by 3 times, we get 360. That's how much salaries that Luscious Landscaping owes to this employee. So to record that, we debit salaries expense for $360, and we credit salaries payable for $360. And now that we have our adjustments in place, we can make our worksheet. So the first thing you want to do is make sure you have all of your adjustments sitting in front of you. Our first adjustment was the depreciation adjustment, and in the depreciation adjustment, we debited depreciation expense for $350. Well, we're going to just take that number, and firstly, yes, it goes to the T accounts as well. I haven't done it in this video. It's going to go from your adjusting entry both to the T's and to the worksheet. So depreciation expense got debited for $350. Let's debit it in the adjustment section of our worksheet. Accumulated depreciation of equipment got credited for $100 in the adjustment. Let's add that to the adjustment section of our worksheet. Accumulated depreciation of truck got credited for $250 in this adjustment. Again, let's add that to our worksheet. In our next adjustment, we debited supplies expense for $200. Let's continue doing that. Bring it right into the adjustments section of our worksheet. We'll also bring in the $200 credit that we had to supplies in that same section. And the next entry, we had a $1,000 debit to accounts receivable, which is going to get moved to the worksheet, and a $1,000 credit to service revenue. In our next adjustment, we had a $1,500 debit to unearned revenue in this adjusting entry. Let's put $1,500 in next to unearned revenue in the debit section of our adjustments column. And then we had a $1,500 service revenue credit in this adjusting entry. Well, we already have $1,000 there on our worksheet. So how much should we have there? Well, let's get rid of that $1,000 and just add it together. We had a credit for $1,000 and a credit for $1,500. So in total, we had $2,500 worth of credits to service revenue during our adjustments. Next up, we had a $600 debit to rent expense that's going to get put into the adjustment section, and a $600 credit to prepaid rent. We had a $40 debit to interest expense and a $40 credit to interest payable. Move those numbers over to the adjustment section. And lastly, we had a $360 debit to salaries expense, which is going to get moved to the debit column of the adjustment section, and a $360 credit to salaries payable. That's our 7 adjustments. So the first thing we need to do is make sure our debits equal our credits within the adjustment section. So if we add together all of our debits, 1,000 plus 1,500 plus 360 plus 600 plus 350 plus 200 plus 40, add those numbers together, we come up with $4,050 worth of debits. We know debits got to always equal credits. Do our credits add up to the same? Well, we're going to add those 7 numbers in the credit column of this adjustment section, and that also comes up to $4,050. So we're good here. Our unadjusted trial balance balanced out. We would have moved on if it didn't. And now we know that our adjustments balance out as well, which means we can go on to make the adjusted trial balance section of this worksheet. And to do that, let's follow these simple principles. If an account does not have an amount listed in the adjustment section, you can simply take the unadjusted balance and move it over to the adjusted balance. If an account is listed in the adjusted trial balance and the adjustment section on the same side, we can add it together. What I mean by that is if you have a debit balance in your unadjusted trial balance and a debit balance to your adjustments section, you can simply add them together because they're on the same side. They're both debits. However, if they're on differing sides, if you have a debit balance in your unadjusted section and a credit balance in your adjustments, you subtract and report the difference between those two in your adjusted trial balance. Confusing? It'll be pretty easy as I work through here. Cash had a debit balance of $16,650. Nothing happened in our adjustments to cash, which means we can simply carry that number over to our adjusted trial balance. So let's move that $16,650 of cash right over from our unadjusted balance to our adjusted balance. Accounts receivable had a $2,800 debit balance in the unadjusted trial balance. We also have $1,000 on the debit side in our adjustments. They're on the same side. They're both debit. So we can add those two together and we come up with a debit balance of $3,800 in our adjusted trial balance. For supplies, we have a $1,000 debit balance in our unadjusted section, but we credited it for $200 in the adjustment section. That's different sides. Unadjusted balance is on the debit side, adjustments is on the credit side. Since it's on different sides, you subtract the two. 1,000 minus 200 is going to give you 800, but it's still an asset, it's still supply, so it should have a debit balance. Same concept with prepaid rent. We had a debit balance of 1,800, but we credited it for 600 in the adjustments, so we subtract and report the difference, which is $1,200 debit balance to that account. Equipment and truck both had 0 things happen during the adjustment, so we can just move their unadjusted number over to the adjusted section. Accumulated depreciation of equipment and truck didn't have a balance at all in our unadjusted section, and we only had adjustments, but they're both listed on the credit side, so let's add them together. And 0 plus 100 and 0 plus 250 is going to give us the same exact number in our adjusted trial balance section. Accounts payable had a $500 credit balance and nothing happened in the adjustment, so we can move that on over. Our salaries payable didn't have a balance, and we credited it for $360 in the adjustments, which means our adjusted trial balance should have a $360 balance. Interest payable should have a $40 credit balance by that same principle. Utilities payable, nothing happened in the adjustment, so let's move that $225 credit balance right on over to the adjusted trial balance. Unearned revenue had a $4,500 credit balance, and we debited it for $1,500 in the adjustments. Different sides, so we subtract and report the difference, which is $3,000. Notes payable, our capital account, our withdrawal account, all three of those had nothing happening during the adjustment, so we can just bring our unadjusted trial balance over. Service revenue had a $3,300 credit balance, and we added $2,500 more during the adjustments. They're both credits, so we add them together. Becomes $5,800 in the credit section of our adjusted trial balance. Same principle all the way down. Expenses should always have a debit balance. If you had something during the adjustment, like we did with salaries expense, you're going to add them together. $2,400 plus $360 is going to be $2,760 as our new balance. Utilities expense is still going to be $225, and we didn't have anything in these last four expenses, so our adjusted trial balance is going to be equal just to the amount that we made during the adjustments. $600 for rent, $350 for depreciation, $200 for supplies, and $40 for interest, giving us a total amount of debits of $56,875. And now we take a deep breath and we hope that our credits equal the same amount as our debits. And when we add up the numbers in our credit column, we come up with that same number of $56,875. And now that you have your worksheet completed, you can go on and you can prepare your financials from this adjusted section. So first you would report your income statement, taking all the revenues and expenses from the bottom of this worksheet. After you found your net income, you're going to carry it over to your statement of owner's equity in the following manner. And then for your balance sheet, you are going to take all of your assets and liabilities directly off your adjusted trial balance, but you are going to take the end value of your capital account directly from the ending number on your statement of owner's equity. And again, at the end of all of this, your balance sheet should always abide by the formula that assets equal liabilities plus owner's equity.